Now we're gonna go over the 4 main things you need to know from a tax perspective for real estate investors. As a CPA who had my own tax practice for many, many years, and a real estate investor myself, this is extremely valuable knowledge that everybody needs to know. The first thing you should know is when you own a rental property, you're able to deduct things like you are for a regular business, such as mortgage interest, real estate taxes, insurance, HOA dues, maintenance, supplies, cleaning, professional services, whether it be legal or rental management services. So there's lots of things that you can deduct that are regular cash expenses that you can deduct on your taxes against your rental property income. The second thing that you need to know is that there's also non-cash expenses that can be deducted, such as the number 1 is depreciation. Depreciation is great. Generally, residential rental properties are depreciated over 27.5 years. However, you can do a cost segregation analysis in which you can separate the rental property into different buckets of personal property versus the real property to have advantageous depreciation at a faster rate. So you might want to contact a CPA or a company who does that to get more information. Also, you have something new or relatively new. It's called the qualified business income deduction, where you can deduct under certain circumstances 20% of your net income against your rental property income. So those are 2 things that are very, very important to know. The third thing that I would say that is very common on real estate investors is they want to sell a property and buy another. And if you want to sell a property and buy another, you can defer the gain on the first property if you do a 1031 exchange and you follow certain parameters that you meet the guidelines, the criteria. You need an intermediary, you have a certain number of days to identify the properties and a certain number of days to close on the properties. But if you follow all those rules, you can defer your gain until you sell the next property, or you can keep rolling it over into property after property indefinitely. So that's definitely a very common thing that's used by real estate investors. So the 4th thing you need to know is that there's passive activity loss limitations. If you're not actively involved in the real estate investing side, then you will only be able to take passive losses against your passive income. It is typical for real estate investment properties to have losses because you're taking non-cash expenses such as depreciation deductions. So in that circumstance, you are limited to take them against your passive income. However, there are other ways to get around that if you are a real estate professional, for example, and you meet those guidelines under the Internal Revenue Code. Then you can take your losses against your other income, but you must meet those requirements. So I suggest you talk to your CPA or accountant to figure out what the rules are and to know if you qualify. Things that sets us apart from other agents is we're able to offer free tax advice for each client's individual transaction. So if that's something that interests you, having a realtor who can also offer you tax advice, please reach out today for your free consultation.